If you're on a flight and the plane suddenly hits, like a massive pocket of turbulence, the very first thing you probably do is look at the flight attendants.
Right. You want to see if they're panicking.
Exactly. If they're strapped into their jump seats, gripping the armrests, and looking totally terrified, you know it's time to panic.
Yeah, that's when you worry.
But if the plane is shaking, the overhead bins are rattling, and those same flight attendants are just, casually walking down the aisle pouring coffee.
You figure it's just a bumpy patch.
Right. We're going to be fine. You look for that reliable baseline of truth amid all the immediate, visceral noise.
And that baseline is often, well, it's the hardest thing to find in financial markets, especially when the noise is just deafening.
Yeah.
You need a way to filter out the screaming passengers to see what the crew is actually doing.
Welcome to today's deep dive, where we're searching for that exact baseline of truth across the global markets. Today is June 26, 2026, and the source material you shared with us for this run is, it's not your standard quarterly outlook.
No, not at all.
We are looking at the output from a custom-built meta-analysis rig.
Which is fascinating.
It really is. It's this highly advanced multi-lens market cockpit. It basically takes live, real-time market data, so terminal screenshots, raw pricing, volatility surfaces.
And then feeds it simultaneously into a stack of different AI models.
Yes. We're talking Copilot, ChatGPT, Claude, Gemini, DeepSeek, Perplexity, and Grok, all analyzing the exact same terminal data at the exact same moment.
Because relying on a single AI model to read the global macro environment has become incredibly dangerous. I mean, every model has its own underlying training biases, right?
Yeah, and its own blind spots.
Exactly. Some over-index on negative news sentiment. Others might overweight historical quantitative correlations that, frankly, no longer apply.
So by cross-referencing live terminal data across 7 different cutting-edge architectures, this rig kind of stress tests the narrative.
Yes, it forces the models to check each other for consistency, and from that, it extracts a synthesized regime call. It strips away the hallucination risk to map out what's really happening in credit, commodities, and equities.
Okay, let's unpack this, because we are feeding an absolute flood of cross-model data into this system.
Yeah.
And, well, the models immediately flagged a massive psychological contradiction in the market.
A huge one, yeah.
So the core question for our deep dive today is, given all this conflicting high-speed data across different asset classes, what is the actual synthesized read on the global market right now?
Well, the AI stack highlights this violent tug-of-war playing out between absolute panic in the equity markets and total, almost bizarre complacency in the bond markets.
It's a historic divergence, right? How risk is being priced.
Exactly.
The data backing this up on the equity side is pretty stark. Looking at the sentiment data the rig pulled, the CNN Fear and Greed Index is sitting down at roughly 25.
Which is officially flashing extreme fear.
Right, extreme fear. And the street is putting its capital right behind that fear. The total put-call ratio is up at 1.0312.
Wow.
Yeah, up 5.6%. We know that when the ratio stays elevated, above that 1.0 threshold, equity investors are actively and aggressively hedging.
They're paying a premium to protect their downside.
Exactly. They are the passengers screaming about turbulence. But then we look at the bond market, and it's a completely different universe.
What's fascinating here is the underlying mechanics of the credit markets when contrasted with that equity panic.
Because they're completely calm.
Completely. If we look at the terminal data for high-yield option-adjusted spreads, the HYOAS, we see the flight attendants pouring the coffee. High-yield OAS is currently sitting around 2.65 to 2.78%.
So that's 270 to 280 basis points.
Right. And the single-B high-yield OAS is pinned at roughly 2.83%.
Those spreads are remarkably tight. I mean, the convex data in the rig flags anything below 350 basis points as the complacency line.
And we are well below that.
Way below. And in periods of classic market stress, when the financial plumbing is actually breaking down, those spreads blow out to 600 or 800 basis points.
Exactly. So the credit dealers are looking at the exact same macro economy that the stock market is looking at, but they are pricing in zero structural stress.
How is that even possible? How can the stock market be terrified, but the bond market is essentially taking a nap?
Well, historically, credit leads equities in episodes of real systemic market stress. Bondholders sit higher in the capital structure,
Right.
and because their upside is strictly capped to their yield, they are notoriously paranoid risk managers.
They don't care about a company's infinite growth potential.
No, they only care about default risk. So if the credit market isn't panicking, the underlying machinery of the economy, the ability for corporations to roll their debt and fund operations, is still functioning smoothly.
So we have a stretched rubber band. The stock market is pricing in a crash, while the bond market is pricing in smooth sailing.
And one of two things has to happen to snap that rubber band back to reality.
What are the options?
Either the macro environment stays benign and equities realize their extreme fear was a massive overreaction, sparking a huge relief rally,
Okay.
or a genuine growth shock hits the system, and credit suffers a violent catch-up widening where those spreads blow out overnight.
And this is where the multi-lens AI setup proves its value, right? It doesn't just average out the two conflicting signals.
Right, it looks for a third variable to break the tie.
So if credit markets are completely ignoring the equity panic, we need an objective referee to tell us who is right.
And that's commodities.
Exactly. Because commodities can't be skewed by pure trader sentiment. They are anchored to physical supply chains, shipping routes, and actual industrial demand.
You can't fake physical demand.
Right. And the models synthesize some major moves in the raw materials of the global economy, starting with oil.
WTI crude has seen a multi-week pullback, settling into the $69 to $73 a barrel range.
The terminal data confirms the broader complex is cooling, with Brent at 72.76.
Down 3.63%.
Right, and late sweet crude at 69.42, which is down 3.48%.
So the trend is obvious, but the rig points directly to the geopolitical supply risk premium being stripped out of the price.
Meaning we are seeing progress on a ceasefire in the Gulf, global tanker flows are normalizing.
And the market is essentially looking at the physical supply chain and pricing out any imminent energy shock. The fee premium in oil is evaporating.
But here's where it gets really interesting. Look at gold.
Ah, yes, the ultimate fear gauge is confirming the oil narrative, but with much more aggression.
The terminal shows gold hovering right around the low 4,000s, specifically 4,086.30 an ounce.
Which might sound high historically, but if you zoom out...
It's a massive 30% collapse from its peak back in January.
Right, when it was sitting at roughly $5,195.
That is a brutal technical breakdown for the premier safe haven asset.
A 30% derating in gold is a profound macro signal.
So what's driving that drop?
It's the unwinding of the safe haven bid under the heavy pressure of a strong U.S. dollar and a significant shift in real rate expectations.
Because if real rates are rising, the opportunity cost of holding a zero-yield asset like gold becomes too heavy for institutional portfolios to justify.
Exactly. If you can get a guaranteed risk-free return in government paper that outpaces inflation, you dump the yellow metal and chase the yield.
It's pure capital efficiency. Now, the models did flag a little intraday bounce in gold above 4,000.
Yeah, but the consensus across the AI stack is that the intraday bounce above 4,000 is purely an oversold technical bounce.
Oh, really?
Yeah, it is not a regime change. It does not signal that institutional fear is returning to the market.
So if we connect this to the bigger picture, the referee has made the call.
The broader macroeconomic regime is actively rotating out of the panic hedge mode we saw earlier in the year.
When gold was pushing 5,600, capital was paying a massive premium for disaster insurance. Now, both gold and oil are aggressively derating.
The credit market was right all along. The flight attendants knew the turbulence was just noise.
Wow. So the AI synthesis concludes the market is shifting into a higher for longer but manageable grind.
Yes. Interest rates will stay elevated to keep inflation anchored, but the underlying economy is resilient enough to absorb that cost of capital without tipping into a recessionary collapse.
Okay, so the bond market had the correct read on the macro environment. But manageable does not mean we are operating in a risk-free environment.
Definitely not.
And this is the crucial nuance the meta-analysis rig uncovered when we drill down into the granular terminal data. Because if you just look at the surface indices, it looks like a calm, glassy pond.
The broad market metrics certainly project a high degree of tranquility.
Right. The E-mini S&P 500 futures, the ES, are essentially flat, sitting at 7397.50. That's down just a tiny bit, 0.35%.
And the VIX, the primary volatility index, is relatively muted at 18.56.
So on the surface, the broader indices suggest a very calm, higher-for-longer regime where everyone is just clipping their coupons and going home.
But underneath that calm surface, the sectors are violently tearing each other apart.
It's a mess down there.
This is where the structural phase of the market reveals itself.
Let's look at the numbers. The NASDAQ 100 ETF, the QQQ, is taking on water, down 1.38%. And that's driven by a brutal almost 4% drop in semiconductors,
The SMH ETF is getting hammered.
down 3.97%, and the individual heavyweights are dragging the chain. ASML is dropping 2.53%.
Taiwan Semi is bleeding out, down 0.61%.
So capital is aggressively abandoning the hardware layer of technology.
But tech itself isn't dying. The capital is just moving next door.
We are seeing a massive rotation into sectors with highly predictable margin profiles.
Right. Tech software, the IGV ETF is soaring over 4%.
4.06% to be
Yeah.
exact. And healthcare, the XLV, is up 3.03%. Even Bitcoin, which is notoriously sensitive to liquidity drains, is holding a very calm floor above 60,000. It's at 60,070.
Capital is fleeing the cyclical, capital-intensive semiconductor space and hiding out in software and healthcare.
Why those specifically?
Well, in a late cycle, higher-for-longer regime, capital expenditures become incredibly expensive. Semiconductors require massive, continuous capex cycles to stay relevant.
Right. You need to constantly build new fabrication plants.
Exactly. When rates are high and growth is slowing, investors abandon companies that need to constantly borrow to build those plants. They rotate that capital into software as a service and healthcare.
Because those are sectors with sticky, recurring revenue models and massive gross margins, they don't require heavy borrowing to maintain operations.
Right. And this raises an important question about the actual mechanics of the market we are currently sitting in.
We have tight high-yield credit spreads, extreme fear in broad equities, a massive de-risking in commodities, and a violent rotation from hardware capex to software cash flow.
So when the AI stack processes all of these intersecting data points, what is the final synthesized regime call?
We are operating in a late-cycle carry-chasing market that has completely exhausted its easy upward momentum, but hasn't yet tipped into full risk-off territory.
Investors are acting under the assumption that this low volatility grind will last indefinitely, which pushes them to hunt for carry anywhere they can find it.
Because growth is slowing, so they're forced to take on incremental, hidden risks just to squeeze out a few extra basis points of return.
They short volatility, they buy slightly riskier tranches of debt, they crowd into the exact same software trades looking for a safe place to park their capital while still collecting a premium.
And that collective behavior creates a highly asymmetric setup for the entire global financial system.
The risk does not equal the reward. We are staring at a massive structural imbalance.
Okay, unpack that asymmetry for us.
Think back to the high-yield spreads we discussed earlier, pinned at 270 to 280 basis points. The ceiling is right above our heads. Most of the credit expansion in this cycle has already occurred.
Meaning there is virtually no room for those spreads to compress any further.
Exactly, which means there is no capital appreciation left in that trade. You are locking up your capital for a tiny yield in an environment where the macro picture is slowing down.
So the upside is completely capped.
Yes, but the floor is miles beneath us. Because everyone is crowded into the same carry trades, assuming a perfect soft landing, there is a massive amount of room for those spreads to blow out violently.
Right. If a sudden policy shock or an inflation surprise disrupts the calm.
The downside convexity is enormous. The market has priced in perfection, leaving zero margin of safety for error.
It's basically picking up pennies in front of a steamroller. So what does this all mean for you listening?
Well, it's like driving 90 miles an hour on a highway using a bald spare tire just to get to work 5 minutes faster.
Right. Sure, the road looks smooth right now, and you are technically making a little bit of extra time, but the tiny upside you are gaining is mathematically not worth the catastrophic blowout risk you are taking on.
If you hit a single pothole, the tire shreds, the car flips, and you lose everything.
This is exactly why you have to care about protecting your downside in this specific regime right now.
The AI models are screaming that the yield you are getting for taking on late cycle risk is fundamentally mispriced.
The sentiment data shows the retail crowd is terrified, but the credit pricing shows institutional capital is entirely complacent.
The structural reality, however, is a dangerous asymmetric trap. If you only look at the broad S&P 500 or the VIX, you think the highway is clear. You don't realize you are driving on a spare tire until it pops.
Which is why this multi-lens meta-analysis rig is such a game changer. Let's pull all these threads together for you listening. This AI stack took a mountain of conflicting high-speed data and found the actual signal buried in the noise.
It revealed a market where equity investors are aggressively buying puts, terrified of a crash. Yet credit markets remain completely unbothered, with spreads tight and default pricing non-existent.
We needed a tiebreaker, so the models looked to physical commodities. Oil and gold are aggressively unwinding their panic premiums.
They are dropping significantly as geopolitical risks fade in the Gulf and real rates rise, confirming that the macroeconomic regime is shifting into a manageable, higher for longer holding pattern.
And finally, under the hood, we saw capital abandoning capital-intensive hardware and semiconductor plays to hide in the predictable cash flows of software and healthcare.
It proves we're in a late cycle carry chasing regime where the risk reward setup is dangerously asymmetric, limited upside, massive potential downside.
Synthesizing all this data through a concurrent stack of AI models provides a level of clarity that, frankly, a single human analyst simply couldn't achieve in real time.
Oh, totally. But, it leaves me with a lingering thought that builds on this entire experiment.
Okay, where does this lead us?
Well, think about it. If this kind of meta-analysis rig, where 5, 6, or 7 different advanced large language models are constantly reading market internals and generating synthesized regime calls,
Yeah.
if that becomes the standard operating procedure for every major institutional trading desk on Wall Street, what actually happens to market structure itself?
Oh, wow. We get a machine-driven monoculture.
Exactly. Do we enter a massive hyper-accelerated feedback loop? If an AI stack at firm A is reacting to the pricing changes caused by the AI stack at firm B.
Which is reacting to the synthesis from firm C.
Right. You could see momentum swings happen at a speed and scale we've never witnessed before. And if every machine is reading the exact same synthesis, optimizing for the exact same asymmetric risk, what happens to the value of human intuition?
That's a great point. The contrarian portfolio manager who looks at all the AIs agreeing with each other and decides they are all missing the blind spot.
Does contrarian human intuition become the most valuable, scarce asset left in global finance?
Or does the human just get run over by the algorithmic feedback loop before they can prove they were right?
Yeah, that's the risk.
It really makes you rethink the mechanics of who or what is actually flying the plane right now. Are the flight attendants pouring the coffee human, or are they just code programmed to project calm right up till the wings snap off?
It's definitely a provocative thought.
It is definitely something for you to mull over as you analyze your own portfolios and risk exposure this week. Thank you so much for joining us on this deep dive. Keep questioning the narrative, keep looking for the mechanics beneath the surface data, and we'll catch you next time.